Great. So I'm Len Kleinrock. I'm director of the UCLA Connection Lab. I'm delighted to invite Blockchain at UCLA to hold this meeting here. You realize you're all guinea pigs. This is the first time we're conducting a large group meeting using all the wonderful audiovisual you're enjoying right now. Let's hope it all works. So we have Ben Tsai talking about careers in crypto. You're all going to become crypto career experts in just a few minutes. So Ben, you're on.
Thank you very much. Thank you. Thank you everyone for coming in. I remember when I was doing college presentations, I would buy pizzas and so forth. So unfortunately we're in COVID, so no pizza for you guys. Yeah, just today, Jason actually invited me to come in and talk a little bit about my career, and I'm happy to share that, and also what I'm doing in the crypto space. And I'll actually start with where I am right now. Right now, I'm one of the co-founders and the president of Wave Financial. We are an SEC registered investment advisor in the blockchain and cryptocurrency space. Our focus is on cryptocurrency asset management and wealth management, and we run over $1 billion of AUM. We're based in LA. We're about a mile west of here, and so that's a quick background on that. In terms of the second part of what I do is I also teach crypto finance at the Anderson School with the Master of Financial Engineering students. So I do that course in the fall. So I actually graduated from UCLA from the business school with an MBA degree back many years ago. And before that, I went to Berkeley actually as an engineer. So that's probably a good starting point for my story. So I grew up in LA, went to Berkeley for engineering, studied material science, ended up going out to Asia and did R&D in the semiconductor space for a number of years. And then realized people are having a little more fun in finance than in engineering. So I thought, okay, let me switch into finance. So I went to business school, and then I went into traditional finance. I did that for about 15 years in Asia. I was with Merrill Lynch for about 12 years. I ran structured products for them across equity and fixed income. And later on, I ran the commodities desk. The bulk of my work was really focused on creating financial products, which is, for what it's worth, actually very engineering oriented. It's about finding a problem. It's about finding the boundaries of a solution, and then finding that solution and delivering to the clients. Thereafter, I moved over to the buy side, which is also kind of finance oriented. I was at AllianceBernstein. I was head of alternative investments for AllianceBernstein across Asia for about 3 years. 6 years ago, I came back to the US, decided to do something different, settle down a bit. My old job, which sounded glamorous at the time, but isn't really so, I was at the airport basically every other day, flying around Tokyo, Hong Kong, Singapore, Beijing, Shanghai, and all the major cities. And I would visit different clients. I would work with the sales teams I'm in charge of. I would talk with the traders in terms of positions and so forth. And I would do it over and over again. So at some point, all that traveling just wasn't very interesting anymore. So came back to LA, parents are getting older, kids are getting older. So came back to LA to kind of settle down, for the lack of a better way of saying it. I looked around and was really looking for a career that I wanted to do, that I was interested in. And the traditional finance, there actually isn't that much of that here in Los Angeles. So working with some people, I got into blockchain and cryptocurrencies. I found it extremely interesting. I was involved with LA Blockchain Lab, so I was the CFO there, one of the co-founders. I did that for about 3 years or so, and that was a little more focused on enterprise blockchain. So we did some consulting for Lamborghini, we did some consulting for Panasonic, and that part of it was actually quite interesting. A lot of these firms didn't really have a view of what they want to do with blockchain, and this is 5-6 years ago, but they really wanted to learn more, so we spent a lot of time with them. Specific for Lamborghini, we were actually hired to do some research with regards to what they can do with blockchain and so forth. And their board comes out to California, once a year to attend the big concourse at Pebble Beach. They would rent a fancy house on the golf course, Lamborghini logos all over the house, and they would fly a chef in, they would do the whole thing, and it's to entertain their biggest clients and really their salespeople, their Lamborghini salespeople. So we attended the party, had the nice food, and then the following day, we spent a whole morning talking to the board of Lamborghini about blockchain usage, and how to do that. It was an extremely interesting discussion. It was great. But the fallout to that is that they said, great, that sounds good. We should do more. they turn around and they call Salesforce.com, right? So at the end of the day, a somewhat volunteer nonprofit group, is never going to be able to support enterprise blockchain, or that was the conclusion that I had come to. So I decided, okay, I guess it's time to pivot back into the finance side of things, which I have some familiarity with. So as another random side note with regards to the whole Lamborghini story, I think all of you who have any exposure to Lamborghini know that Lamborghini is very much a symbolic thing in the crypto space. There's a whole when Moon, when Lambo type of joke. We talked about that with the Lamborghini people, and they're like, we don't get it. I said, what do you mean you don't get it? They're like, Lamborghini, we stand for engineering excellence. I said, no, that's not how your marketing department is working at, right? So we had a hard time telling them about that and convincing them. They're like, no, that's not a good representation of Lamborghini, because we really want to show that we're excellent engineers. We build really good cars. And I said, yeah, that's not quite the image that you're projecting out there. So it's funny. I mean, the C-suite, really the members of the board are seeing a reality, I guess, they want to see, which may not necessarily match up with the rest of the world. So these are kind of interesting tidbits that have nothing to do with crypto, but I think is very interesting as an experience. About 3 years ago, I decided to pivot more full-time back into the finance side of things. I started an RIA here in California, a registered investment advisor, which allows me to help manage assets for clients. And when we did the application with two of my partners, we decided to put down that we are going to do crypto. Took a while, we got our license, and then I realized I didn't really have any clients that are very rich. And the people I knew who had some crypto didn't have a lot of crypto and weren't about to put a lot of money into crypto either. So for a wealth management business, it doesn't make a lot of sense. For example, if I'm making 1% of the asset I'm managing or 0.5% of the asset I'm managing, I would need to manage a lot of assets for it to make sense for me as a business to run, for the expenses I'm incurring for running a business and so forth. So I put that on the shelf a bit, started consulting with firms that are in the crypto space. That was during the ICO boom, saw a lot of things. And I was shocked at a lot of engineers doing finance without knowing finance. And it's the new world. We don't have to worry about the rules of finance anymore. We're doing this new thing. And a lot of it didn't really make a lot of sense to me. So I thought, okay, this is where I think I could add some value with my experience on the finance side. I ended up meeting the partners that are on this page, David Seymour and Les Borsay, and the three of us started Wave Financial. So we're all founders of the firm Wave Financial. So that's kind of the beginning, and I could talk a lot more about Wave Financial, but I'm going to pause here, and I'm actually curious. What do you guys want to hear? What do you guys want to know? Coming here, do you guys have any questions? Do you have, is there something, anything you want to hear and know about what I do? And I'm happy to get into a lot more detail. If not, I can go over, what type of products we do, how we handle crypto, the nitty-gritty details of it, and then how it applies to, CS majors. I assume a lot of you are CS majors. I'm assuming a part of you are not CS majors. I actually wasn't given an exact breakdown, so it would be curious. But I'm paused here just to take kind of directions, questions, anything.
What the transition was like from engineering to finance, and whether there's stuff that you feel like helped you or hurt you?
Sure. Yeah. The transition from engineering to finance was very difficult. I think it's probably the right way to say that. I was in Japan at the time. I had spent a number of years in Japan as an engineer, both as a service engineer and as a research and development engineer. I was working for one of the top firms in Japan, and I thought, great, I should be able to do whatever the heck I want. It's a very American way of thinking about it. But in Japan, it doesn't work that way. If you're an engineer, you're with the engineering guys. If you do finance, you're with the finance guys. If you're an engineer, you want to do finance, there's an IT department, you can go and do that. And IT wasn't really what I was looking for. I didn't want to maintain networks and so forth. I really wanted to get into the finance of things. So, instead of trying to, and I know people who do this, but it's very difficult to get into the IT side and try to support the finance and then slowly move your way through and try to make that transition. So what I ended up doing was I decided to go to business school. The beauty of business school, it's like coming out of college. When you come out of college, you can do whatever you want, basically, right? You come out of a decent college like UCLA, you pick a job. To a large extent, they let you do whatever you want. Even if you were a CS major, you wanted to do business, they'll probably let you do it. If you're a business major, if you want to do CS, obviously, if there's some technical skills you'd have to fill the gap at. But to a large extent, college is like a golden ticket. You kind of are qualified to sign up for whatever the heck you want to do. And going to business school is like a second ticket. Once again, I get to decide what I want to do. Put my hand up, I want to do finance. I was a summer intern at Merrill Lynch. This was during the summer where everybody was doing .com and nobody wanted to go to traditional finance. So that was also the year they stopped wearing ties. Everybody went to business casual. And yes, I'm dating myself a little bit. This is a while back. So this is the year 2000. So I put my hand up and say, hey, I'll do investment banking. They said, great, please come. I said, well, I've got some conditions. And this is funny because years before and years since, you don't dictate conditions to investment banks. When they take you as an intern, you say thank you and you go. But I said, no, I want to do half of my summer in the US and half of my summer in Asia. They said, okay, let me come back to you. 2 weeks later, called, yes, done. I said, I want to bring my wife. They're like, oh, okay, I'll come back to you. And then 2 weeks later, call, okay, done. You bring your wife, half and half, let's do this. So I ended up doing that. It was a great experience. It was probably the only time they did that. And just as a random side story, at the end of it, for everybody that got an offer, they invited everybody to Puerto Rico. Spent a week in Puerto Rico. Senior management showed up, talked to everybody. Hi, what's your name? You got an offer. Did you sign yet? And if the answer is yes, you signed. All right, great, have a good time. If you say, no, I haven't signed yet, they give you a whole spiel. You should join our firm. It's the greatest thing ever, blah, blah, blah. And it was just that time. That was, there was really a fight for talent and so forth. And you're seeing that now again for fight for talent, maybe not on the investment banking side, but certainly a lot of the major, big firms, big tech firms are doing a lot to try to recruit and retain talent. So that's the type of thing you see. Take it to an extreme. We checked in the hotel. Once again, I brought my wife. We were in Puerto Rico, checked in the hotel. On the bed, there was a bag, a goodies bag. There's a Merrill Lynch towel in it. There's a Merrill Lynch throwaway camera back when they had those, with a little dial and everything. And then there was, they put $100 room credit just in case I wanted to order room service. And they even have little sandals where you can walk on the beach and it leaves little bull marks on the ground, So that's kind of how far that went. So that was the first, last, and only summer they did that, by the way. So it was interesting. So back to your question, I think that transition was not easy, but I think it was something that you can do if you were to, for example, go to school either for MBA or something more technical and you come out of that. MBA is nice because it means you haven't made a decision yet. You can still do whatever you want after MBA. But if you pick a technical master's, obviously, that gives you a direction. You're closing doors on some of the other options. So when I was going through college, I never thought about what I wanted to do with life. When I was in high school, it was like, whatever college I can get into, what is the best I can do? So I went to Berkeley, signed up as a nuclear engineer. Who wants to be a nuclear engineer? I don't know. I signed up because it sounded difficult, but it sounded like it was a minor degree that maybe I could just get in easier. Signed up, went, and realized I don't want to be Homer Simpson. I don't want to work in a remote location because nuclear plants are never in big cities, right? So, I transitioned to material science and so forth. And because of that, when I went to business school, I thought a lot about my career and what I want to do and did a lot of research and so forth. And I think that was a good thing. So hope that helps. Please.
Yeah, you said that you were trying to get into finance in the early 2000s around the .com era.
Yes.
I was just wondering, around that time, obviously, the .com bubble, have you seen a lot of the similarities right now, kind of the professional recruiters and the differences?
Yes, definitely. I think we're seeing the same thing. We're seeing it kind of happening probably in a more accelerated fashion. I'll talk about the 2000 first. I went to business school in 99 to 2001. 99, 2000, people were dropping out of business school so they can go do their startups. It was just like that extra year was not worth the time, And at, fall of 2000, internet bubble burst. A lot of people then applied to try to come back for those people that have delayed the second year of their business school and so forth. And it was kind of a tricky situation. I got an offer from Merrill Lynch, and I know a number of people were looking for excuses to renege people's offers and cancel people's offers by 2001. And it was just tough because it became a lot tougher environment. There's the Asia financial crisis also, and the whole thing just kind of was difficult. We're seeing, we've kind of seen a few cycles of that in crypto already. Everything in crypto happens faster, I think. So you're seeing that cycle happen a bit faster. We went through the 2017 kind of ICO bubble where Anybody who can write a business plan or what looks like a white paper will get funded for millions of dollars in tokens, nothing else signed, no equity ownership, nothing given up, no liabilities, sometimes not even a company, just a business plan and some tokens, right? So that's pretty extreme. I think that has come and gone. People have realized that it just doesn't work that way. SEC has also cracked down quite a bit. I've separate presentations I do with the Anderson School about kind of the whole regulations around that and how people are, there's a whole regulatory issue around that also. So that was kind of the first major boom. And thereafter is 2.5 years of crypto winter. And that was the crypto winter where we built Wave Financial. So the first 2 years of our career was very difficult. At Bitcoin at between 4,000 to 7,000, sometimes went up, sometimes went down. We're like, wow, this isn't going anywhere. And then late 2020, it went from 7,000 to 20, 30, 40,000. That's when we started kind of business really kicking in. And we feel very fortunate because we built the foundation, we built the infrastructure, we built the people, and the platforms start taking in assets. So our assets increase very significantly. So we've gone through that positive cycle. With that said, I think there is still a lot of new and different things that are being built, and it's I don't know if you call it creative destruction. There's a lot of stuff being built, things that work, things that don't work, and just kind of going through iterations of that. And because this is so new, and then after kind of the first iteration, kind of the less robust business models fall apart, the more robust models stay, and on top of that, the regulatory environment kicking in, stabilizing it. That gives you kind of a bigger foundation for you to then build into more different things. And you saw that during the internet period, the internet bubble, and you're seeing that right now in crypto also. I feel like it's still the experimental part. So we are, kind of the most leading edge of this, and we have an expert in Jason here to talk about it. So I'm almost hesitant to get into too much detail, but the DeFi space is, the new and nascent space. It's a real use of blockchain technology for finance if you just ignore the regulatory side, right? And, I say that not to make fun of it, but I think there is a discussion of what does the regulatory environment look like if it was applied to DeFi? How do we handle that? We spend hours and hours with lawyers on this, on how we can get comfortable with counterparties that we can't see, and so forth. There are OFAC issues, there are all sorts of other issues. And I'm throwing out random terms. So anything that you don't know, just put your hand up. Happy to get into more details on everything. But those are things that we're working on, we're struggling through. So funny side story, as we started Wave Financial, we kept trying to get reduce our legal bills because we were a startup. So we were going with cheaper lawyers. But as we became more and more profitable, we started using better and better lawyers, and better lawyers, to a large extent meant, bigger and bigger legal bills. So right now the lawyers we're using are charging $1,800 to $2,000 an hour, right? So whereas we were using, $900 an hour lawyers when we started, $900, that's a lot of money, and now we're using twice as expensive lawyers. And these people would be on a call with, 2 partners and 2 middle level people and 2 juniors. And I was thinking, wow, we're getting billed for all of that. So yeah, but the regulatory environment is a new thing, and you've seen that also kind of in the internet space, right? Uber kind of pushing the boundaries on legal, Airbnb's always pushed the boundaries on legal, and that's a global thing, right? So I lived in Taiwan for a year, during my work career with AllianceBernstein, and I used Uber in Taiwan. I heard that they launched that year and they've closed down since. So I'm lucky that there was that window of anomaly. I was there for a year and I used Uber the whole time. And the regulatory environment just changes, and some places work, some places don't. We go to Japan a lot. Airbnb doesn't really work in Japan, for example. So we're kind of seeing that part of it also with regards to the crypto environment. A lot of what you're seeing, a lot of services, a lot of DeFi, a lot of drops, a lot of NFTs, a lot of them, they don't take American clients. They're like, if you're from the US, you can't come on. If you're using a US ID, we will not take you. And that just comes from kind of a difference in recognition of, regulatory environment. So I won't get into too much detail there, but, happy to discuss that offline. Yeah. Please.
I noticed that the big enterprise, most of the big box people like Salesforce use it as enterprise
Sure. Yeah. No. That's a good question. I think that the problem I see with that is a number of folds. One is that I think enterprise blockchain works really well when you're looking at intercompany systems, like across multiple companies, consortiums, and so forth. If you're a single company, you need a single thing to manage your data, get a database, right? There's no need to put stuff on the blockchain. It doesn't need to be public. It doesn't need, you trust your own employees or you get rid of them, right? There's no need for a blockchain system. When you get to intercompany systems and so forth, you can do a lot of interesting things. But typically, it's driven by larger organizations and also by larger consulting firms who span across these organizations to be able to do that. That was simply the comment I was trying to make. As we were, I think the team we put together for Lamborghini was about 4 deep. I was on that. We had our CEO on that. We had a few other people on that. But it was never going to be the Salesforce level of size, right? You got Lamborghini, like what's the CEO's name? Benioff is pitching Lamborghini directly himself, right? I'm not competing with Benioff on the pitch, right? So he's got how many people at his disposal for that implementation to be done and so forth, right? They had the Lamborghini CEO at the Salesforce conference to speak on stage as a keynote. I don't have those resources, right? So it's difficult on the enterprise side to make a dent. I'm not saying there's no career to be had there, right? It's just that career will be part of a larger organization, which once again, that's not a problem. I worked with large organizations most of my life. There are benefits to that. I'm in a startup. There are benefits to this also. There's also downsides and stress to this. So it's just a different way of looking at it. In terms of looking at opportunities that haven't yet been explored, I think there's actually a lot. One of the biggest things that I've looked at and talked about, for a while now that I haven't seen it into fruition very much is the idea of supply chain management, but on the finance side. And I think, you hear a lot about, the coffee bean grower will grow the bean, we'll track it on the blockchain, we'll send it out to the roasters, roast it, grind it, drip it, and then you get your cup of coffee. There's a barcode, you scan it, you can know exactly where that bean came from. Great. What fertilizer was used on the bean. Great, right? For me, that's not as interesting. The interesting thing is actually going the opposite way. A client pays for a product, that money flows upstream. It goes to the retailer, it goes to the wholesaler, it goes back to the manufacturer, that whole chain. Once you have that chain on a blockchain and you're doing all the settlement and all the finance on the blockchain, you can then look at financing, you can look at credits, you can look at opening and closing credits with collateral or just credit. One example I use, which is completely theoretical, is if you look at Apple, they make iPhones, right? Their supply chain is really, really, really long, lots of parts and stuff. From Apple's perspective, they kind of don't care about any specific player in there. All they care about is the supply chain flowing properly and everything is properly supported. What they want to do is they want to make sure that the supply chain flows through. So if everything was on the blockchain and we're doing this, supply chain finance chain going backwards, what they can do is they could provide a line of credit every time their product is flowing through that. The credit line will open when a supply would go into one sub supplier, and they would process that thing. And once they're done, they deliver it. That line of credit would close, and everything could be done on a smart chain automatically, for example, right? So from that perspective, that's something they want. Apple does not want their letter of credit just randomly floating around in space, but they do need to provide credit lines for some of these smaller operations to work properly, right? And they can't just buy every single person on the supply chain. They do a bit of that, but they're not going to buy the whole supply chain. So that's just a very generic example. And it's funny, I think, I want to say one of the Japanese companies, and I'm trying to remember which one I can't, one of the Japanese companies in Citibank actually was trying to build something like this in the 80s. And that was before there was blockchain technology. And they failed because they didn't have a technology that could do this. They were trying to string a bunch of databases together, and that was not a successful project. But now that there is technology for it, the concept I thought was actually quite good.
And follow-up.
Please.
Just out of curiosity, have you heard of, as part of one of those enterprise use cases for financial firms, there's something that Polygon's working on with UI called Nightfall. I was just wondering.
I don't know specifically about Nightfall. I mean, we've worked with Polygon on and off on certain things. We look at Polygon on a regular basis. We use them on the DeFi side. So I don't know specifically about that project, but I do know there are a number of projects already on the finance side. And I know some of the larger financial players are all coming up with their own solutions to this. And I think the question really is on whether they can get consortiums going, they can get other people to participate and try to expand that. For example, JP Morgan wants to issue their own token. Mitsubishi in Japan has said they want to issue their own token and they want to run it through, a stable coin on their own. They want to run it through their own settlement layers and so forth, right? So as an example, those are the type of enterprise usage things that could be interesting. And they will have to consolidate with other people so everybody can use it together, right? So, and in a weird way, I mean, the whole Facebook stablecoin thing was exactly that, right? That was what they wanted to do. Those guys kind of lost the plot because they went and told everybody they were going to do this and conquer the world before they even started. If they just did it and then tell everybody they were doing it, they probably would have gotten away with it. So I think the other thing was that they were too aggressive in saying that they're going to create a basket of currencies and they were going to be the controller of that. And that's taking sovereign power out of sovereign hands. And you can see governments immediately reacting to it globally. If they had just said, hey, I'm going to do a US dollar stablecoin, they probably would have gotten away with it. They had bought USDC, which they can afford. They buy Circle. They at the time they probably could afford to buy Coinbase. They would have gotten away with it. But it was they gave away their we're going to dominate the world plan before they started, and people said, no, you can't do that. So not a fan, but just poor execution. Sorry, please.
Yeah, question about your NFT fund. So I was looking it up and I saw that I think 70% is invested in directly NFTs and 30% infrastructure. And that seems like contrarian based on what I've seen other funds doing. So I'm curious how you came to the conclusion to invest the majority directly into NFTs, and then what category of NFTs beyond collectibles do you see your fund investing in?
There are multiple discussions with regards to that decision. I'll tell you the boring answer and I'll tell you the interesting answer. The boring answer is by having over 60% of our investments in NFTs, which are not considered securities, we can sell the fund to as many people as we want. If we had more than that, it would be considered a securities product regulated by the Securities Act of 1940. And 1940 is a long time ago. But anyway, so we would be restricted to selling to 99 investors. So that is the boring answer to that question. The interesting one is, I think a lot of funds were already investing on the NFT venture side, protocols, platforms, issuance platforms, marketplaces, and so forth. We didn't feel like that was an interesting thing. We decided to pivot more into the NFT collectible side. We probably would have considered doing it completely on the NFT, just the collectibles themselves. But because of our deep relationship with a lot of these places and us getting involved in the drops and so forth, there were opportunities that are very unique. So we said, hey, why don't we leave ourselves a little mandate to be able to do some on the VC side also, so that we get a balance of the two. And they've both done extremely well. So we've launched this fund. It's been only running for 2.5 months. We're up 110% or something like that. So yeah. Thank you. So I mean, it's a hot market. I think it's really a market beta discussion rather than an alpha discussion. We have some great relationships. We're involved in a lot of drops. We have a few guys that are good at finding the right collections to be in and so forth. And that's on the more let's call it the crypto side of NFTs, your crypto punks, your Bored Apes, type of products. And those are more driven really by the crypto crowd. It's a bunch of guys with a lot of ETH running around and punting it. So, the valuations are the valuations, but that's the space we're currently active in. With that said, as a firm, we're also looking at the more traditional connection with the more traditional space on the NFTs. Those are not expanding as much in valuation, so we're not investing as actively in there, but we keep our eyes open. And I know I said that in a very mysterious way. Let me just kind of get into a little more detail on that. Just as an example, we're speaking with a lot of the sports teams in the US and Europe, people like Manchester United and Real Madrid and so forth. In Europe and the US, we've spoken with sports teams in the baseball, football, basketball leagues and so forth. And we talked about NFT funds. We speak with musicians about NFT drops. Our chief strategy officer actually has a music background. So he was a music manager for Winona Judd before that, with Jason Mraz and a few others. And so he's very connected on the music side. So, we actually did, he helped with the drop of, for example, some of Diplo's NFTs, some of Marshmallow's NFTs, and so on and so forth. So, so we look at that. We've been speaking, because we're in LA, we've been speaking with the movie studios about taking some of the movie IPs in there. Into the metaverse. Imagine your big action films, whatever you can imagine. Imagine being able to be in a metaverse like that, and be able to spend time there, be able to, have a currency in there that runs around. That back to kind of the cryptocurrency discussion. Those are very interesting. I've recently been involved with Vogue Singapore about fashion and NFTs. Not that I'm a fashion guy, so I'm wearing my Way Financial sweatshirt, but thought that that's also very interesting. So I think that second wave of valuation drive, and the second wave is going to be more mainstream. There's a limit to all the rich crypto people punting NFTs. There needs to be kind of mass adoption, or you're going to run out of fuel of kind of the excitement of people buying collectibles. The other thing I think people don't realize, but haven't thought about it very much, is you look at people trading NFTs for hundreds of ETH, and each ETH is like $3,000-$4,000. You're like, wow, that's a lot of money. A lot of those guys bought those ETH at 50 cents at the drop, right? So from their perspective, it's a few $100s from their purchase price perspective, right? So it's a little easier for them to pull the trigger on big ETH numbers. So something to kind of keep in mind. And I think that experience, that way of thinking, is not replicated to the masses. The rest of us didn't buy ETH at 50 cents. So, it's hard for us to participate with the valuation of, okay, if I went to buy ETH today at $2,000, $3,000, and then to buy the NFTs, how much is that? Oh, that's a lot of money, right? So there's a bit of that gap there. So, yeah. Hope that answered your question. Sure. Please.
What is your overall crypto thesis? So let's say macro 10 years from now. From the sounds of it, I feel like the thesis is that there's a lot of absorption by current enterprise and current businesses with this technology. Whereas I kind of feel like it's a new industry, and people will be developing things native to the industry instead of being adopted by the current. Is that just right?
I think that is a hard question, and I think to a certain extent we've pivoted, within a general thesis. We pivoted a number of times, even within our firm. So I'll talk about that actually in great detail, and I'll come back to questions, thereafter. I think that the facetious answer is nobody knows what's going to happen in crypto in 10 years. I don't even know in 2 years, right? So the 10-year planning is going to be a tough one. With that said, we've run our business really from a wealth management, asset management perspective. As the core theme for me is that crypto is the next asset class to be included in the financial world. So I used to run commodities for Merrill Lynch, and commodities was not a thing 20, 30 years ago. 30 years ago, if you want to do a commodities trade, you call some banker in Texas, they get you done. You don't call New York, you don't call Wall Street. They don't do commodities. It's very blue collar. And then Goldman Sachs went and bought J. Aron. Merrill Lynch bought Entity Coke from the Koch brothers. And JP Morgan built their own desk, and all of a sudden the race was started. People are doing commodities. They already had a set of clients. Investment banks, the whole point is they have a whole bunch of clients. They added the capability, they made a lot of money. Merrill Lynch, I think, paid $2 billion for Entity Coke's commodities business. They made $2 billion in the first year. Everything thereafter is gravy, right? So it was the right decision. They had the clients had demand, they bought it, they're in that business. After that, you saw ETFs being launched in oil, in gold, and things of that nature. That's not a coincidence. When the investment banks get involved, they say, hey, we can also do that, let's do that. And then you're seeing commodities being accepted as an asset class into traditional finance, new things pop up, new products go. Funny side story. When oil and gold first started, they were doing gold futures and oil futures ETF only. And they said, wow, what a stupid idea, because futures are traded at a premium to spot. Why the heck don't we just buy the spot thing? At first, oh, we're not comfortable. Maybe it's a manipulated market. We don't have the clarity. We don't have liquidity. Futures only. And then after a while, they got comfortable. They had the spot version. And now you can buy spot gold version ETFs where the gold is stored in some storage somewhere. And it's actually pointing to gold instead of gold futures contract for future delivery. Guess what? The Bitcoin thing right now, we're in the first half of that exact story. Oh, Bitcoin prices may be manipulated. We don't know. Because of that, let's use Bitcoin futures prices, because the futures prices aren't quite as manipulated, because these are contracts that are traded on a regulated exchange. Great. So now you have a Bitcoin futures ETF. But the problem with the futures ETF is future trades at a premium to spot. And every time it gets close to maturity, the trader will buy the next one up, which is also at a premium. So every time you roll their futures, you give away some economics to people who are providing liquidity on the other side. At some point, we think the SEC will approve a spot Bitcoin ETF, because it's stupid to do it the other way. It's expensive for investors for no reason. So we think that'll get approved when they get comfortable with Bitcoin, finally, of trading Bitcoin. So we're seeing this thing play out is kind of what I'm trying to say. And I would not be surprised at some point if all the investment banks will have a crypto trading desk, and that will probably sit between the commodities desk and the FX desk, right? So I don't know if you guys are familiar, right? On a trading floor, you have your equity desk, you have your bunch of fixed income guys. Within fixed income, you have the bond desk, you got the FX desk, you got the rates desk, you got the commodities desk. And I'm thinking between the commodities desk and the FX desk, you can have a crypto desk, because there's some similarity there. So that is the big picture theme that I'm driving myself on with this whole, I want to be in crypto finance. And then within that, I said, look, what can I do in crypto finance? And think back 3 years ago. 3 years ago, I looked at getting a broker-dealer license. SEC was not approving them. There were 40 applications or more in line. They said no to every single one of them. So we couldn't become an investment bank in crypto, because SEC said no such thing, cannot do it. We looked at RIAs. I got the license. Off we go. I took some exams and so forth. Most of our front office people have an exam as an asset manager, wealth manager. So Series 65. So we did that. And within asset management, we said, what can we do in that space? We looked around, right? What we saw was a lot of what's called the 1.0 product. They're access products. For example, the GBTC, the grayscale product, it's an access product to Bitcoin. And you're seeing a lot of access products, just giving people exposure. At the same time, charging people a lot of money and so forth, right? I don't think those are great products. So we said, okay, we can build better access products. Let us do that. We also saw a lot of VC funds, and we had some VC funds, and I'll talk about our products in just a bit. I then said, what else can we do, right? Asset management using traditional assets, it's actually a very, very nuanced thing. There's equities, there's fixed income. Within fixed income, there's high risk, low risk, high liquidity, low liquidity. When I was at AllianceBernstein, we were doing an infrastructure debt fund. We were selling 10-year lockup funds with a target yield of 3%. Who wants that? When they first came to me, I said, I can't sell that. That's crap. I would never buy that. They're like, it's not for you. It's for insurance companies. It's for people who have 10 plus year horizon. They need a stable cash flow. They need it forever, and they don't care. This is all they buy. I said, okay. So we actually went to, this random side story. We went to Korea, and we went and visited all of these insurance companies and pensions. They said, yeah, that's exactly what we're looking for. I said, really? Why, right? And I think other institutions agree with me. I was in Taiwan. I talked to an insurance company. It's like, why do I want that? I can punt that and punt some bonds and make 3%. I don't need to wait 10 years for that, right? So I said, yeah, you're probably right. So different markets, different clients, and so forth. So I said, what can we do in the crypto space? So we looked at lending platforms, and this is centralized lending. So you're facing out the counterparty, you're taking credit risk, you're lending dollars, you're lending crypto, you're getting paid a yield for that. We have those services on our platform. We looked at derivatives, right? Derivatives, there's the traditional equity derivatives, there's fixed income derivatives, and now there's crypto derivatives. You can do futures, you can do call options, you can put options on Bitcoin, on ETH. There's a listed market. I did a few $1 million of covered call trades on Bitcoin for our product this morning as a hedge. It was the last Friday of the month. The options expired. I rolled it into a new set of options. And we created this product called Wave BTC Income and Growth. This is a fund where a client gives us money. We take the money, we buy Bitcoin, we hold it on their behalf at a qualified custodian. At the same time, we go and write call options on it. It's a pretty simple strategy. It's called call overwrite. People do this in equities all the time. What you do is you're generating a stream of returns for these call options, but you're capping the return at a certain level. Bitcoin volatility is really, really high compared to everything else, right? You know, your Tesla stock doesn't trade as high as Bitcoin in terms of volatility, right? It's just I wouldn't say a magnitude different, but it's like probably twice as volatile. Because of that, we're able to write a call option and pay out really attractive returns. For example, for our product, we're targeting 1.5% yield that we're paying to clients a month. So imagine 3% a year for 10 years versus 1.5% a month every month, right? That's the premium we're paying out from the premium generated from that option. If you took equities and you sold an option, you know, the way we do it, like 20% out of the money, 15, 20, 30, 40, 50% out of the money, you generate no premium. There's no premium for a 20% out of the money option for 1 month. But for Bitcoin, we're paying out 1.5% a month, right? On top of that, because we're moving the strike out, I'm saying your Bitcoin can grow up to 15%, up to 20%, up to 30% a month. And you're not capped. That cap doesn't hit until much later. So this product, including the dividends and everything, we were up about 190% in 2020, right? That sounds great, but you know, Bitcoin was up 300%. So I mean, I want to be realistic, right? This is designed for the cash flow. Rich people, when they invest, they're looking for that cash flow on a monthly basis. Yes, it's good to get the upside. We got the upside. We got 190 out of 300. Nobody's complaining. They also got a monthly cash flow, bank money in the bank. Happy. In 2021, we were up 90%. All of you know, Bitcoin was up 60%. So we actually outperformed Bitcoin because the coupons that we paid out actually was bigger than you know, as a return stream compared to the gains and losses. So there are scenarios, and it's a path-dependent scenario. So there are scenarios where we will outperform Bitcoin. There will be times we will underperform Bitcoin. And you know, in a bad scenario, if Bitcoin just goes down one way all the way down, we will outperform Bitcoin because we're paying 1.5% coupon on the way down, right? For example. So you know, from that perspective, I think we have a solid product. It will not outperform Bitcoin when Bitcoin is going through the roof, but it will do well in these environments with a cash flow, right? That's the type of thing that we want to use traditional technology, but apply to crypto. We can probably launch the same product on Ethereum, and we would get better returns because Ethereum vol is about 10 points higher. Implied vol is 10 points higher. So that's the 1.0 and the 2.0, right? What's 3.0? What's the difference? 3.0 is when you have technology that is dependent on the fact that it's on a blockchain. It's different from the traditional assets. Because crypto is on a blockchain, there are a lot of things we can do. Staking, DeFi, tokenization of assets, NFTs. All of these things are unique because we're now on a blockchain. We're taking advantage of the blockchain technology. And we're in the process of building products around it. We've just launched a Cardano DeFi fund. We're pooling assets and we're using assets to invest in the new Cardano ecosystems that are being spun up on the DeFi side, right? We're supporting the launches of those. Not all the platforms we'll sponsor will work well. So this is kind of like VC investment. We think a few will do really, really well. We'll get really high returns from us providing liquidity to those. And a few is not going to do well. They're probably going to blow up and we're going to lose money there. But overall, we think we'll do well on the ones that do well to offset the ones that don't do well. It's more of like a VC model where, you know, you have investments and, you know, you have a few outstanding investments, you have a few decent ones. It offsets a few that end up not doing well. We're trying to do a US dollar market neutral fund. Right now, we are going to launch this. We're going to take people's money. We're going to convert to stable coins. We're going to lend that liquidity out into the DeFi space. We're going to try to generate 8 to 15% returns for people, with very minimal volatility. So Jason and I were talking about volatility of stablecoins before. Most stablecoins are within 0.5% to 1% annualized volatility, and that's extremely low. At the same time, most of these lending pools have very high liquidity. We can get in and out very easily, and at the same time, the yields are very high. Right now, there are no traditional assets where you can make 6, 8, 10% return with full liquidity with no market exposure, right? So that becomes a very interesting product. And that's what we're putting together right now. So because of that, we're talking with lawyers, all the hair around DeFi and all of that. And then on the NFT side, we're doing the NFT fund. I talked about it a little bit. I can get into it a little more, but I'll leave it there. And the last thing we did 2 years ago was a Kentucky whiskey fund. So we have a private equity fund that we bought whiskey barrels. I actually went out to Kentucky sources. I went out 3 times the first 6 months, talked to all the people there, learned about it. We bought 2,700 barrels of whiskey in Kentucky. We're storing it right now. 2,700 barrels is equivalent to roughly about 500,000 bottles. Just kind of put things in perspective. And we own this and we're aging this. So the aging process, if you buy it and you age it for, let's call it 5 years, we're typically looking at 3 to 5x return on that. It's not super exciting by crypto standards, but we're talking about buying a hard asset, leaving it on the shelf, right? I'm not doing anything. It's just going up in value 3 to 5x over 5 years. On top of that, we're insured. So if something was to happen, insurance will pay me out at market value. So there's very little risk for the return profile we can get. We thought this is very interesting. We wrapped this in a private equity fund. And the key part of this is we're tokenizing the equity ownership of that fund so that there are tokens that are available for trading. The fund itself has no liquidity. I know it's a whiskey fund, so it's funny for me to say that. But the fund itself has no liquidity. You can't trade the fund on its own, right? But since we created tokens, we list the security tokens on security token exchanges and trade that and so forth. So that's conceptually what can be done. So one last thing, and I'll get to you. The issue I have right now with that fund is actually none of the guys that own it want to sell. And therefore, I'm kind of on the fence as to do I even bother issuing the tokens, because if nobody wants to sell, why bother? So that's where I'm a little bit stuck. So yeah, please.
Curious about what other kind of tokenized real world assets you guys are looking into your future funds, like real estate or.
So on this, we spent a bit of time looking at it, and it was something that was very interesting to me. Coming from a traditional asset space, I thought that that's something that I would love to do more on. And so we did the whiskey fund, and we looked at a whole bunch of assets: clean water, carbon credit, Japanese racehorses. I had a corporate client who wanted to tokenize Japanese racehorses. Like, you would own it, the cash flow out of winning races would get paid out, and when the horses get older, the stud fees would get paid out, and so forth. We looked into it, and you have to be either Japanese or Japanese corporate in order to buy a Japanese racehorse. You can't just walk in and buy a Japanese racehorse. So tokenization, fractionalization would also provide some real value to access a market that's closed. So, we looked at that for quite a while. In the end, we didn't do it, but we've looked at a lot. We looked at real estate. A lot of people looked at real estate. A lot of Asian clients are looking at that. It's very interesting for them. Japan actually is, all the major financial institutions are involved in blockchain, but not crypto. And they want to do tokenization of bond, tokenization of real estate. They're really looking at this as a very traditional thing, and they're completely ignoring the crypto. It's like, it didn't happen, that kind of thing. So that is going on, certain parts in Asia. So, so that's an interesting thing. The tokenization of real estate is a tricky one in the sense that there are a lot of legacy regulatory things that make it a little bit difficult to operate. And I think, we were looking at some companies who have taken a very aggressive stance there and said, these tokens are not securities, just don't worry about it. And then they've had to pull back from that stance because it's not very clear. From my perspective as traditional finance guys, most of these are securities. You're investing, pooled investments. I don't know how you get out of this is a security question, but people are trying. The flip side of that is the regulations on the other side is starting to loosen up. When we first started this business, Reg CF, crowdfunding regulation, there's an exemption for crowdfunding for sourcing, and used to be capped at $1.07 million. Now they've opened that up to $5 million. At $5 million, you can now do real tokenization projects, right? So I think it's interesting. Things are starting to open up if people are willing to go down somewhat of a regulatory path. And in the US, the regulatory path, I would say, is relatively clearer than some of the other countries. The other countries just don't have regulations, and one day they may tell you you're in violation, and it's like, well, it doesn't say, and it gets tricky. So, sorry, yes.
Yeah, I think we've worked with a couple times, but have you ever tried to work with regulators directly to like change some laws or introduce new asset classes or types of funds that were not before as not being regulated or have you ever
We have more from a group perspective. We haven't ourselves directly gone to the regulators. I think what we've decided on for all that we do, we want to just stay within the existing regulation bounds. And then we're part of some groups, like we're part of AIMA, the Alternative Investments Management Association, and so forth. They have a working group for digital assets. So, they do comments. We're part of GBBC, Global Blockchain Business Council, which is a New York-based group. They're also, quite active in speaking with politicians and regulators and so forth. So through these representation, through the membership of what we do, that's how we're getting our representation. We are not ourselves actively in dialogue there. We don't quite have the scale there, right? If you look at, kind of the people that are being called to Capitol Hill to speak, right? You're talking about really the Coinbases of the world, the FTXs of the world. We're not quite there yet. We're working on it, I guess. So. Yeah, so those we provide our comments through these groups for the AIMA and GBBC as we look at this. So it's unfortunate, but I think the lobbying groups within crypto are still a bit more fragmented. It's not as as organized, and this is part of the whole decentralization, right? The decentralization makes organization of these things a lot more difficult, and very interesting personalities in crypto also, as you I'm sure know. So it's hard to get everybody to kind of agree to push in a single direction. So when you have a few major monopolies, it's much easier for those guys to set a lobbying agenda and push in a single direction. So yeah. I think the other side of things, which if given an opportunity to speak with regulators, is really about the fact that I think I know it's silly for me to say this, but to a certain extent, I think the self-regulatory nature of crypto has actually worked really well. You've seen more than 5, 6, 50% crashes in a short period of time of the crypto market, probably in the past 3 years, 5, 6, maybe more. And there was $0 spent on bailing anybody out. I mean, everything just kept working, right? There's no discussion of, we're going to close the markets down, circuit breaker. Okay, we're going to stop trading. Everybody stop panicking. We'll come back. We'll take a deep breath, and we'll come back and trade again, right? That's what the traditional markets do. But there are no circuit breakers. You just trade, right? If one exchange goes down, you just go to another exchange and trade, right? So there's no stop. It'll just crash the way it crashes. In theory, that should be worse. There should be more painful, more volatility. And yet the crypto market is more healthy and didn't require a bailout. There was no tax money spent on any of those losses. The losses are spread across kind of the holders, right? So I think, overall, I think that's been pretty good. It's not perfect. There's still a lot of shady characters in the space. There's a lot of issues with that part of it. But overall, I think, there are some merits to this fail fast type model where if it fails, the community is taking it and then we move on. So. I don't know. I think that the current regulators are a little bit more bearish, with the understanding that the train has left the station on the regulatory side. It's a little late to say, Bitcoin, that doesn't work, right? And it's a little bit late for that. So they understand that there are so many investors involved at this point, it's a little late to stop certain things. So they're trying to put in regulations to try to at least rein it in and kind of stop new stuff going out that would be more damaging, right? So I think they're starting to look at stable coins, they're starting to look at different things. But with that said, I think it's not I don't know if they're going to implement their regulations on smart contracts. I don't think they need to. They'd actually have to pick which smart contract, they have to pick winners and losers. I just don't think they'll get there, yeah.
Yeah, I was just wondering, what is the fee structure
The fee structure on the whiskey fund, if I remember correctly, is 1 in 15. So we charge 1% management fee. No, sorry, I take that back. We decided to take, instead of, we decided to take 5% upfront, 1% running, and 15% performance fees. I think that was the number. Yeah. For our NFT fund, I think it's 2 and 20. Our VC funds are 2 and 20. Our Bitcoin income and growth is 1% plus 5% of premium. And our index fund, which is just the top 5 cryptocurrency monthly rebalance, we're doing 1% on that.
You were talking about how you were looking at Japanese resources. You ended up landing on whiskey, but you guys had plans of looking for wine.
Whiskey has the best return profile out of all the assets that we looked at. With the least volatility, the least risk, we were able to wrap our head around it the most. And we decided to go with that. Wine is very fragmented in terms of white wine, red wine, rosé, which region, what kind of grapes. It's much more fractured market. So it's a lot more difficult to manage the inventory. Whiskey is actually relatively easy. I'm already having people call me and ask if I'm willing to sell them my 1.5-year-old whiskey. And I said, it's only a year and a half. They're like, we don't care. There's just not enough inventory. And they'll blend it. They'll do whatever they need to do to get their hands on, aged Kentucky whiskey.